Okay, students, let's continue our review for your semester exam in finance. Some definitions for you. Negative cash flow, spending more than you make. Positive cash flow, spending less than you make. And again, these two definitions can be flipped around. Negative cash flow is when you earn less than what you spend. Positive cash flow is when you earn or you make more than you spend. And we talked about these two terms when it comes to budgeting, and the goal is to end up with a budget in positive cash flow. The stealing of someone's personal information, that's called identity theft. The use of someone's personal information to commit crimes, that's known as fraud. We talked about economic specialization. That's where people, businesses, they focus in on a particular skill or stage of production to increase efficiency and output. We talked about how the Middle East specializes in oil production. Parts of central Pennsylvania used to specialize in coal mining. So as opposed to the entire process, you focus in on one particular aspect to increase your efficiency and your output. Supplemental Nutrition Assistance Program, SNAP, that was formerly known as food stamps. We discussed shrinkflation, where manufacturers decrease the size of a product but keep the price the same. And this statement is true. Customers don't react to producers downsizing a product size as they do to increasing the cost. So let's say you go into the store and you buy your favorite box of cookies, and every day your cookies are $3. So $3 today, $3 tomorrow. If they increase the price of cookies to $4, customers are really aware of that change. But if they keep the price of cookies as $3, and as opposed to giving you 12 cookies in the box, they only give you 10, that's less noticeable for consumers. So it's called shrinkflation, where they downsize the amount that they're giving you, but they keep the price the same. We talked about the fact that the cost of food is increasing so dramatically, and we gave many different reasons why. First of all, the truck driver shortage. We talked about how the government is limiting the amount of driving that truck drivers can actually do. The cost of shipping containers overseas has increased dramatically. The cost of labor global has been increasing. And there's been some weather events that are affecting the production of food. So there's many different reasons why the cost of food is increasing so dramatically. We viewed a presentation on tipping and the phenomenon of tipping becoming increasing widespread and expensive is known as tipflation. And we saw how there's people who make the federal minimum wage for tipped employees. It's only $2.13, and that value was set back in the 1990s and still has not changed today. So if you're a worker that receives tips as part of your job, the worker only earns $2.13 from their employer. Businesses asking for a tip before the service has been completed basically pressure the customers into leaving a larger tip. So that's true. And newer technologies have contributed to the tipflation. Kiosks, tablets, now when you go to pay, they have tipping suggestions that pop up, and these suggested amounts are oftentimes larger than what customers would actually tend to tip for these services. And the average tip for full-service restaurants today is closest to about 20%. So 20% of the bill is the normal full-service tip at restaurants. We viewed 10 different businesses for our Finance Friday presentations. Starbucks, Chick-fil-A, Spirit Halloween, Target, Sephora, the Dollar Tree, Kia, Chipotle, and Costco, and then you had for homework, Aldi. So let's go through these different statements and describe the business that it, accurately explains. Fast casual, we talked about that's the category that Chipotle fits into, fast casual. First in customer satisfaction, Chick-fil-A. Chick-fil-A ranks very, very high when it comes to customer satisfaction rankings. Small and efficient, that's our Dollar Tree, Dollar General. First to embrace the use of mobile apps, we talked about Starbucks. And by using these mobile apps, not only did they increase profits, but they collected data. So data collection. Theft issues and social media trends, that's Kia. Increasing its inclusivity by selling many brands at their stores, that's Sephora. A higher-end discount store, that was Target. Stores are disorganized, bare-boned, and messy, that's the Dollar Tree. Short-term leases, that's Spirit Halloween. Remember, they come in for the Halloween season and then they're gone for the rest of the year. Customer connection score, that's Starbucks, where basically customers rank their experience at their Starbucks. Owns all of its locations, picks all of its locations, builds the stores themselves. Chick-fil-A, we talked about they are ultimate control freaks when it comes to their business, so that would be Chick-fil-A. A warehouse, buy in bulk, that's Costco. Keeps the number of menu items smaller than most restaurants. Here I'm going to accept two answers. Chick-fil-A doesn't have a very, very large menu, and it's basically their chicken. And also we talked about how Chipotle really doesn't have that many menu items. Yes, they're very customizable, but by having fewer menu items, both Chick-fil-A and Chipotle increase the efficiency and decrease the chance that a mistake is made when making their food. Their products are changing constantly, so shoppers can find something new. That was the Dollar Tree. We talked about how there's a treasure hunt philosophy. Also, for that one, Costco. Costco is always changing their products. You never know what you're going to get, so I would accept those two answers. The Time Capsule Collection. Target is known for their Time Capsule Collection. Judeo-Christian values. That's Chick-fil-A. They're closed on Sundays. Service-based retail model. That's Sephora. When you go in there, there's a customer service representative helping you purchase what you want. They make money on membership fees, but sell items as cheaply as possible. That's Costco. Upstream ordering. That's Chick-fil-A. That's their process of ordering to a person that's holding a tablet while you're on the drive-through line. They inherit an empty store, and everything for merchandise, displays, and fixtures need to be set up. That's Spirit Halloween. Spirit Halloween and their challenges of stocking the stores and hiring workers. Uses its pre-existing stores as warehouses for its e-business, its e-commerce. That's Target. And 75% of the U.S. is within 10 miles of a Target store. Sales agnostic. That's Sephora. They sell many different brands of makeup. Low-income Americans are the target audience. That's the Dollar Tree. Talks of employees attempting to form a union in the Buffalo area stores. That is Starbucks. Has among the highest markup, charges more than the sticker price in the automobile industry, yet people still buy them. Well, that's Kia. Has some of the shortest days to turn, time to sell in the industry. That's also Kia. The fastest growing grocer in the United States. That's Aldi. In addition to its low prices, attracts customers with its private label items. That's also Aldi. And using social media and influencers to attract a younger audience. That is Chipotle. So that's a review of some of our Finance Friday businesses from this semester. Now we're going to work on some potential written questions for your semester exam. This first one deals with the budget for Josh and Antonia. It says they're both 43 years old. Josh works for his company and earns a net monthly income of $5,050. That's more like it. So the income column is the plus. Antonia runs her own business. She earns a net monthly income of $3,500, so that goes in the income. And they also receive $150 a month from previous investments. So their other income is $150. They share an apartment where their monthly Payment is $3,000. They're married, so the rent, $3,000. They try to save $400 a month for a dream vacation, so that goes in the savings column. Their utilities are $350 a month, so we're dealing with the electric, the water, so we got $350 for the utilities. It says their family plan for their phone is $100 a month, so cell phone, $100. These are some of the fixed expenses. Gas for their 2 cars, they average about $150 a month, so $150 for gas. They donate $100 to their church, so gifts, donations, that's $100. Their internet package is $150 a month, so that's TV, internet is $150. Insurance costs them $175 a month, so let's list our insurance payments at $175. They lease a Nissan Pathfinder for $550 a month, and they're paying for a Ford Explorer, which is $450 a month, so together their car payments are $1,000 a month. They budgeted $250 a month for entertainment. Groceries cost $1,000 a month. They budgeted $200 a month for any repairs, and they budget $200 for all other types of expenses. So basically what we're going to do is we're going to put that last $200 under the other category. So that, I guess, includes clothing and personal care and some other expenses. So now what we want to do is this. We want to find the sum of the fixed expenses, the sum of the variable expenses, and then the sum of the income and the savings. Take a moment, try to calculate all of those sums. Now, when you think you have all of your columns added, you can take a look here. The sum of the fixed expenses, $47.75. The sum of the variable expenses is $1,900. So now we're going to add the $47.75 and the $1,900. We're going to add the fixed and variable expenses. So here their total expenses, $6,675. So that goes in the total mixed expenses column. If you add up their 3 sources of income, the 2 salaries, and then their investment where they're gaining $150. Remember, income is money earned, so that's in the positive category. Their total monthly income is $8,700. So first what you're going to do is you're going to take your $8,700, your income, minus your expenses. So in this case, their total is $2,025. But since they're saving another $400, we're going to subtract that, which means their cash surplus is $1,625. So they have a positive cash flow because that $1,625 is positive. And then for the year, we're going to take that $1,625 and multiply it by 12. So their cash surplus for the year is $19,500. So it looks like these people, their budget is in a good shape. They have a pretty good positive cash flow. Finally, what we're going to do is we're going to fill in one of those frequency distribution tables for a set of data. So take a moment, pause the video, enter your data into your calculator. Here they're giving you 25 data values. It looks like the time, rounded to the nearest second, that 25 selected customers spent waiting in line at a bank. So you want to enter the data into your calculator, and then I have my data here. You want to sort the data. You want to press Stat, and then option 2 for sort in ascending order, and then just tell it which list you use. So if you use list 1, you press the second button followed by the number 1, and then what it'll do is it'll take list 1 and you press enter. And then when you go back to your list, the key is you have to follow this button sequence. Do Stat, number 2 for sort A, second and 1 for list 1, and then enter. And then when you go back to your list, Stat and Edit, now the numbers are going to be in ascending order. Then I have the numbers in order for us so we can fill in our frequency table. And recall that there are 3 columns that you need to fill in. the frequency, which stands for how many data values are in each interval. The relative frequency is the percent, what percent of the data is in each interval. And then we have the cumulative frequency, which is a running total of how many data values you have represented so far. So let's fill in the frequency column. Let's fill in the how many column. Here the frequency of the first interval is going to be 3 because there are 3 data values, 75, 98, and 121. Those are the 3 data values that fall between 50 and 124. And then the frequency for the second interval, we're counting up all the data values that are between 125 and 199. And it looks like the frequency turns out to be 15. If you count up how many numbers are in that interval, we're going to have 15. Then the next interval from 200 to 274, it looks like our frequency is going to be 6. And then finally the frequency of the last interval from 275 to 349, there's just 1. And always make sure when you fill in your frequency column, your how many column, get the sum of the frequencies. 3 and 15 is 18. 18 plus 6 is 24, plus 1 is 25. That should match the data values that are given to you. So the frequency column stands for how many. The relative frequency stands for what percent. I don't want to know for the relative frequency that 3 data values are in the first interval. I want to know what percent of the data is in that first interval. So the way you calculate the relative frequency is you take the frequency of the interval divided by the number of data. The frequency divided by the number of data. So the first interval, the frequency was 3. The number of data was 25. So you're going to do on your calculator 3 divided by 25 to get 0.12. So the relative frequency is 0.12. What does that mean? That means 12% of the data are between 50 and 124. 12% of the people had to wait between 50 seconds and 124 seconds when they were online. The second interval, its frequency was 15. So on your calculator, you do 15 divided by 25, and you get 0.6. And we always round to 2 decimal places. So I'm going to make it 0.60. That means 60% of the data is between 125 and 199. Our third interval, its frequency is 6. So if you do on your calculator 6 divided by 25, you get 0.24. And then finally, your last interval, its frequency is 1. So when you do 1 divided by 25, you get 0.04. So 4% of the data is in that last interval. So the frequency stands for how many. The relative frequency stands for 1%. And now the cumulative frequency. That's just a running total. So what you do is you start off with the first interval. You start off with its frequency. Its frequency is 3. So far, we have 3 data values represented. But now the second interval, we have this 3 plus this 15. So 3 plus 15, so the cumulative frequency is now 18. The third interval, its cumulative frequency is 3 plus 15 plus 6. That's going to give you 24. And then the fourth interval, its cumulative frequency is 3 plus 15 plus 6 plus 1, or 25. And the significance is the last box in your cumulative column always matches the data, the number of data that were given to you. It always matches what they call the sample size. So that's a good review of another written type of question for your semester exam.